All right, welcome back to another explainer. Today, I'm putting on my hat as a seasoned, highly skeptical equity research analyst. We are going to conduct an investigative, no-nonsense financial teardown of InterContinental Hotels Group, or IHG, based on their newly released first half 2026 fundamentals. We're cutting right through the corporate PR and digging straight into the 6K filings, the margins, the debt loads, and most importantly, the competitive valuations. So if you want to know if this hospitality giant's financial engine is actually as resilient as they claim, you are definitely in the right place. Let's get into it. But real quick, before we hit the numbers, we have some mandatory housekeeping. Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism. Okay, our tone today is objective, data-driven, and completely hype-free. Here is our structural agenda for today. First, an H1 2026 earnings reality check. Second, defining the economic moat. Third, the competitive valuation gauntlet. Fourth, consensus and capital returns. And finally, the final analyst verdict. Okay, Section 1. H1 2026 earnings reality check. Let's start with the hard numbers. As an analyst, my very first job is to completely ignore the flashy headlines and figure out if the underlying business is actually growing, especially in what is undeniably a volatile macroeconomic environment. And look at the sheer scale here: $18.2 billion in total gross revenue across IHG's hotel system just in the first half of 2026. That's up 9.1% year over year. It's a massive, massive number. But as we all know, top-line revenue is vanity, profit is sanity. We really need to see how that massive gross number actually translates into operational success for the company itself. Digging deeper into the financials, we start to see the actual mechanics of their profitability. Global revenue per available room, or RevPAR, which is basically the gold standard metric in hospitality, is up 4.1%. And that's driven by solid rate and occupancy gains across all their regions. They hit a net system growth of 5% and achieved a record 197 hotel openings in the first half. But here is the critical analyst takeaway. Check out that fee margin. It expanded by 1.2 percentage points to reach 65.9%. What this shows us is highly positive operating leverage, meaning their 7% fee revenue growth easily outpaced their 4% cost growth. That dynamic right there, that's the engine driving their $665 million in operating profit. And this perfectly illustrates the executive narrative of resilience. CEO Ali Maalouf is highlighting the core thesis for the company right now. They're balancing accelerated demand in the US and growth in Greater China to offset some of the current challenges in the Middle East. By leveraging that incredibly efficient cost base we just talked about, they drove adjusted earnings per share up by an impressive 13.3%. Simply put, the business is executing exactly what it promises on paper. Moving on to Section 2. Defining the economic moat. Let's look at how IHG protects these margins and builds them into a structural competitive advantage, what Morningstar and hardcore value investors love to call an economic moat. The absolutely crucial point to understand here is their asset-light model. IHG doesn't actually own most of its physical hotel buildings. They franchise the brand and they manage the operations. By drastically minimizing capital expenditure, meaning they aren't the ones constantly pouring billions of dollars into fixing leaky roofs and replacing worn-out carpets, this framework converts an incredibly high percentage of their earnings directly into free cash flow. It's literally a fee-generating machine. When we map this business to standard economic moat sources, the picture becomes crystal clear. Their intangibles are wide, boasting 21 brands ranging from Holiday Inn all the way to InterContinental. The network effect is absolutely locked in with over 160 million IHG One Rewards members, which drives a ton of direct bookings. The cost advantage is super evident in that staggering 65.9% fee margin we mentioned earlier. And finally, efficient scale. This asset-light approach consistently yields a return on invested capital, or ROIC, well above 20%. They are just highly, highly efficient at compounding capital. All right, Section 3, the competitive valuation gauntlet. As an equity researcher, you never look at a stock in a vacuum. We have to pit its metrics directly against its global peers to see if the market is actually pricing it correctly. And this lays out our reality check. Look at the multiples. IHG trades at 20 to 22 times forward earnings and 14 to 16 times enterprise value to EBITDA, which basically measures their total value against cash earnings. At first glance, you might legitimately ask, why on earth should I pay that premium when Accor and Wyndham are sitting right there with much cheaper multiples? Well, we have to justify this premium by looking under the hood of Accor, Hyatt, and Wyndham. Let's start with Accor. Sure, Accor might look cheaper on paper, trading at 12 to 14 times forward earnings, but honestly, as an analyst, I see a classic value trap here. Accor has a significantly more complex business structure, they have higher leverage, and historically, they have lower profitability. IHG's premium is fully warranted in this matchup because they offer significantly higher quality earnings, better operating margins, and a remarkably clean, disciplined pure-play structure. You absolutely get what you pay for. Now, what about Hyatt? The market currently loves Hyatt's ongoing transition to an asset-light model, which is exactly why it commands a really steep premium of 18 to 20 times EV to EBITDA. But here's the catch. You are paying a very high price for a growth story that is still playing out, and it's wrapped in a more capital-intensive legacy model that is totally vulnerable to economic downturns in the luxury segment. IHG, on the other hand, offers proven high-margin cash flows right now at a much more reasonable 14 to 16 times EV to EBITDA. For sure, it's the far more attractive risk-adjusted play. Finally, against Wyndham. Now, Wyndham runs a highly efficient franchise model, and yes, it's slightly cheaper at 16 to 18 times forward earnings. However, Wyndham is heavily concentrated in the highly competitive, lower-rated economy segment. This limits their pricing power and exposes them deeply to the volatility of budget travel cycles. IHG's premium is absolutely justified by its immense pricing power across 21 diverse brands, spanning everything from essentials to luxury and lifestyle. They are just way more balanced. Okay, moving into Section 4, consensus and capital returns. Let's look at the forward indicators. What is Wall Street expecting? And more importantly, how is management actually returning their massive free cash flow to shareholders? Visible Alpha Consensus, which is compiled from up to 15 independent analysts, shows RevPAR definitely stabilizing. They're forecasting 2.8% growth in 2026 and 2.5% in 2027. So what does this tell us? It tells us the explosive double-digit post-pandemic revenge travel boom, yeah, that's officially over. The business is settling back into a mature, sustainable rhythm. If you are modeling this company today, you are modeling for steady, high-margin compounding, not explosive top-line surprises. But check this out. The sheer volume of capital being distributed right now is staggering. Over $1.2 billion is on track to be handed back to investors in 2026 alone. To put that into perspective, that is equivalent to 5.8% of their entire market capitalization at the start of the year. This right here is the ultimate undeniable proof of the asset-light model's cash generation capabilities. Let's quickly break down that capital allocation strategy. They are executing a massive $950 million share buyback program. On top of that, they've hiked the interim dividend by 10% to 64.5 cents, a growth rate they have managed to maintain consistently since 2022. They generated $360 million in adjusted free cash flow just in the first half of the year. And crucially, they are doing all of this without risking the balance sheet. Their net debt to EBITDA ratio is responsibly anchored at 2.63 times, meaning they have ample ability to service their debt, keeping it perfectly within their target range of 2.5 to 3 times. Which brings us to Section 5, the final analyst verdict. Let's synthesize all these models and multiples into our final verdict. Verdict 1. IHG is fairly valued. You aren't buying a deep value turnaround play here, but you also aren't overpaying for some speculative growth story. Based on the comparables and their underlying cash flows, the premium multiples they hold over peers like Accor and Wyndham are fully justified by their best-in-class margins and highly durable cash conversion. Like we said, you're paying a reasonable price for a truly exceptional, high-quality business. Furthermore, verdict 2. Their economic moat trajectory is expanding. This is definitely not a static company resting on its laurels. They are fueling future fees with an incredibly aggressive global pipeline of nearly 348,000 rooms. Think about that. That pipeline represents a staggering 33% of their current system size. With organic signings up 8% year over year and 11 newer brands successfully scaling to capture totally different market segments, their ability to sustain those high ROIC metrics looks incredibly secure over the medium term. So the fundamental models, the pristine balance sheet, and the massive capital returns all point strongly in one direction, toward a highly resilient compounder. But as analysts, we always have to remain objective. Hidden macro headwinds, like softening lower-income consumer demand or sudden regional geopolitical disruptions, suggest a storm could always brew in the travel sector. So the ultimate question remains, which side are you on? Are you buying into this resilient, asset-light cash machine, or are you waiting out the macro storm on the sidelines? As always, do your own homework. Thanks so much for joining me for this explainer, and I'll see you in the next analysis.